Welcome to the another session on your working capital management. Till now, we have, after estimating the working capital needs of a farm, we have been talking about the various sources that can be tapped by a company for getting the working capital finance. Till now, we have discussed out of these sources of finance, we have discussed the trade credit, and we have also talked about the loan or the finance available from the commercial banks. So basically, trade credit and commercial bank credit are the two sources that we have discussed till now, which can be used to get the funding for the working capital of a particular farm. Now, however, of late, the commercial banks they are tightening their credit policy. I mean, becoming more stringent in order to, while granting the working capital loans. So, because of this new norms of stringency, what is happening is the companies which need working capital, they find it very difficult to raise the finance from the commercial banks. So obviously there is a search for new sources of finance which can be the funding can be taken for a short term basis and can be used for working capital purpose. Now even the equity market has not been very optimistic these days, so it has remained on in a quite subdued conditions. So because of the condition of equity market, now the corporates tried to tap the debt market, and they have successfully uh, been able to do so, and for short term debt. So in the search for this thing, I mean this source of newer source for working capital, a lot of financial engineering has also happened in this area, so that the companies can have sources which are non-bank, because now banking norms are becoming stringent. So the company the I mean, the providers of capital, they have also found out various systems of going for non-bank source of finance. So under this non-bank source of finance, we'll talk about few, such as the public deposit or the bonds and debentures or the factoring services. So what two or three sources, non-bank sources of getting the working capital finance is what we'll be discussing in this particular session. Now we'll start with the first thing, that is the public deposit. Now you see these when we talk about public deposits, these are the deposits. These are basically unsecured deposits, and these are accepted by the companies for a very specific period. And I mean, when I'm talking about a specific period, it is basically a short term, and the interest rate is also stated on that particular deposit for that particular period. Now these deposits have I mean become popular of late, because the companies are finding it very convenient, and they are getting the funds from the public at a very cheaper rate. So that is why it is becoming it is gaining prominence every day. Now this is also a perfect example of decentralization, because you can get the capital from the public directly. Obviously that you are going to get the fund through the help of brokers, but intermediaries have been ruled out in this particular kind of financing. Now obviously there are certain rules and regulations that the company which is going for public deposit has to be there. Now the as per this public deposit is governed by the Companies Act 1956, and specifically the section 58A and 58B of the Companies Act, it governs this public deposit conditions. Now there are several modifications, amendments also done to these things. Now see the legal position, I mean, as far as the new Companies Act of 2013, it has there is a little bit change in the legal position. Now, the new section in the Companies Act which pertain to this deposit, earlier which was 58 A and B, it is now under new Companies Act, it has become 73 and 76 for this public deposits. Now, as per this new act, now there are certain terms and conditions that have been laid down by the Companies Act, where you can talk about this public deposit conditions. Now, there are several conditions for that. I'm just picking up the most important ones for discussion in this class. Let's see. No company will invite or will accept deposits from public unless there is a specific criteria as specified by the Companies Act and the clause 73 and 76. If you don't meet that criteria, you should not, I mean, you cannot basically accept the deposit from the company, and neither should you invite for public deposit from the the public in mass. Now, what is that? One of the conditions is that you should have a net worth of 100 crore, or you should have a turnover which is not less than 500 crore. So only then you can be eligible to get the to be able to raise the public deposits. So two things here. Number one, that net worth, we all know the meaning of a net worth. Net worth is the paid up capital plus reserves. That gives you the, if at all you have preference capital, you can also add that. If that net worth is 100 crore, minimum of 100 crore, or your turnover every year is, let us say, 500 crore, then it's then you're eligible to accept deposit from the public. Now, before you do invite the public deposit, you should get a credit rating from the rating agency, and you have to publish it properly. So credit rating is basically, you are talking about the public deposit, the issue that you're going to have. You have to get a credit rating for that particular issue. You will also create charge on the asset equal to the amount of issue. Now, suppose you are raising public deposit to the tune of 200 crore, then you have to have like in the last class, we talked about the charge against the asset. It can be hypothecation, mortgage, general lien, those kind of things. So you have to create a charge on an asset which is worth 200 crore. Okay, so these are all basically, you have to get a security for that. Now, the other companies, like for example, what are the other companies? Except for these public companies and these the other companies which do not satisfy this criteria, cannot invite from the general public as a whole, but they can accept deposits from their own members. The members who are there to the company, you can accept deposits from your own members. Now, when we talk about the deposits, there could be certain terms and conditions for this deposit by companies, and there are some that you have to obey some terms and conditions. There are several terms and conditions, but I have picked up only a few so for discussion. So we'll be talking about the first term, one of the major term, that is maintenance of liquid asset. Now, when we are talking about maintenance of liquid asset, you see the company which is accepting the public deposit, it is required to deposit or invest before the 30th of April of each year an amount which shall not be less than 15% of the amount of its deposit, which will mature during the next financial year ending 31st March. In which place? Now, the whole issue is, suppose for an example, suppose 2024-25, we're talking about 2025. Suppose the financial year 2024-25, it is from April to March. So what will happen is, suppose in this particular financial year, your 200 crore of public deposit is maturing in the next financial year. So the point is, it is maturing on 31st March 2025. So what will you do? You will, on 2024 April 30, what will you do is, you will deposit 15% of this 200 crore in a, where will you deposit? You can deposit in a current or a deposit account, which is with a I mean the scheduled bank, which is with a scheduled bank. Now, this deposit or all these things, this should be free of any charge or free of any lien. Now, you can where you can deposit again. You can in unencumbered securities at the central or state government. So when we are talking about again unencumbered, there is no charge on these kind of securities. So there is no other obligation in these kind of securities. Or you can park this 15% of the fund in where the in unencumbered securities with trust funds and which may be invested under the Indian Trust Act of 1882. It can also be deposited in the unencumbered bonds issued by the HDFC. Now, the point is when I'm talking about depositing the cash free from lines, free from any charge, or depositing in various securities, approved securities which are unencumbered. So basically, the essence here is that whatever you are doing, you should keep these assets or these deposits free of any other charge. Okay, so that there is some safety margin that is being built into the public deposit, that your at least your assets are liquid. If there is an encumbrance on the asset, then even if you want to dispose of the asset in a particular time, you would not be able to do so. Even if these are very marketable assets, but you will not be able to do so if there is an encumbrance on them. So the point is the companies that specifies that whenever we're talking about public deposits and maintenance of these liquidity, it has to be unencumbered, free from any charge or lien. Now we can talk about the rate of interest. Now you see the rules of this Companies Act. It prescribes that the maximum rate of interest, I mean, should not be below a certain range or should not exceed a certain range. Now, what is the rate at present? At present, the rate has to be within the limit of 15% per annum. Now, obviously, when you're talking about raising the public deposit through the help of brokers, so naturally you have to take the help to the, I mean, you have to pay brokerage. Now, even for the brokerage, there is a rule that you cannot pay brokerage to any broker at a rate of 1% of the deposit for a period of to 1 year. If it is a duration of 1 year, then you can pay at least 1% of the total amount of deposit as brokerage. Or if you're talking about period more than 1 year but less than 2 year, you can charge, I mean, you can pay brokerage of 1.5%. And if it is for a period of more than 2 years, then the brokerage applicable to you is 2% of the level of deposit. So then you talk about the advertisement. Now every company which is talking about going for the issue of public deposit, it must go for advertisement. Now every company that intends to invite or accept deposits from the public has to publish advertisement where the minimum requirement is that you should have it in a national daily, which is preferably in English, and one vernacular newspaper in the state wherever the company's headquarters is in. Suppose we're talking about a company which is headquartered in Odisha, then one of the advertisements has to be in the Odia language in a local daily. The other advertisement could be a national paper and preferably in English. The advertisement must be issued on the authority and in the name of the board of directors of the company. So, who is to be given as the issuer of the advertisement? It is some authority of the company or the board of director. Now, the advertisement must also mention the various conditions for which the deposit, the various conditions mentioned in the deposit. So that has to be mentioned in the advertisement. Now, before issuing an advertisement, the copy of the advertisement has to be delivered to the registrar for registration of the same. So this is a mandatory requirement for public deposit. And when we're talking about the advertisement, what should be the part of the advertisement? Name of the company, date of incorporation, the business that the company carries out, what are the subsidiaries, what are the branches or the units you have, the names and addresses of all the occupation of the directors that has to be given in the advertisement, the profit of the company, I mean, before making provision of tax, after the tax, what is the dividend history that you have in the past 5 7 years, the summary of your financial position, the I mean, the amount that the company can raise by the way of these public deposits, and all these things have to be a part of the advertisement. So basically, what I am trying to tell you is the advertisement should be such that the investor who is interested in your company, in your deposit, can get some idea about the company. Obviously, he can do due diligence, he can go for searching on the internet about the company, but the advertisement should contain detailed information about the company, and so that the investor can frame some opinion about the company's financial status and all that. Okay, now having done that, you have to follow proper procedure of issuing the public deposit. Now, like for example, you have to appoint agents, you have to go for the documentation process, the application has to be invited from the, I mean, the depositors. Now, in which bank these transactions will be done, how the receipt is to be given, all these details will have to be carried out. Now, once you get the deposits, now they are required to keep these deposits in the registers. Okay, and the maintain a proper register for this particular deposits. Now, what you can enter in the register, you can enter the name and address of the depositor, the date and amount of each deposit, the duration for which the deposit is being accepted, the date on which you are going to repay, the rate of interest applicable to your deposit, the all these details are to be maintained in the deposit register. Then you talk about the repayment of the deposits. So when we talk about the repayment, the depositor, whenever he desires premature repayment, the companies can do. But obviously, see, for example, if you are invited a public deposit for a period of 1 year, and you have promised a return of, let us say, 9%, but the depositor wants his money back in 9 months. So, will you pay him the 9% interest? Obviously not. It is just like if you are liquidating a fixed deposit in a bank prematurely, then the bank will also charge you a penalty in terms of a reduced interest rate. The similar is the case with the public deposit. So, if a depositor desires premature, repayment, then you can do that, but you will reduce the low interest rate from let us say from 9% to, as per the contract, which will also be known to the depositor, maybe at a 1% or 1.5% or 2% penalty, you can liquidate his payment. Now, if a company permits the depositor to renew the deposit before the expiry of the period, the company will have to pay interest to, for example, my tenure is over. Now I don't want to liquidate my deposit, but I want to renew my deposit. That means I want to further keep my money with your company for another period. So, for that, what is the rate of interest that you can charge? That is payable. Now, if you have to pay a higher interest than what you did in the first cycle, if this deposit is renewed for a period longer than the unexpired period of the deposit. Okay, so suppose 3 months was remaining, he goes for deposit again for another, let us say, 1 year, then you have to give him a higher interest rate. The rate of interest which was stipulated at the time of acceptance or the renewal of a deposit is reduced by 1% for the expired period of the deposit and is paid as an adjustment. Okay, that is how your interest is to be charged. Now, the company can return the deposit for any particular year before 30th of June, and as per the information given in the register of deposits as of the 31st of March. Now, there could be various penalty in various circumstances. So, there will also be deduction of tax of 10% at source. Now, if the aggregate interest that is being paid during one particular financial year is exceeding 40,000, then you have to charge TDS of 10% at the source. That means before you disburse the interest, you will have to charge the 10% of tax rate. Obviously, that is only when you have the interest payment exceeding 40,000 rupees. Now we come to the next instrument, that is the commercial paper. Now you see, commercial paper is another source of raising the short-term finances. Now the point is, these are the it is not that every organization that is operating in the industry, everybody can issue commercial paper. To issue commercial paper, now see, basically when we are talking about issuing commercial paper, we're talking about raising finance on the short term basis from the public. So it is obviously the regulators look out to see how the public doesn't get cheated. So if you allow every company to issue commercial paper and raise money for the short term from the public, the guarantee of the principal of the public's money is not there. So basically, there might be a scenario when the company is not able to repay the amount. So it is not that every company is allowed to issue commercial paper. It is only those companies which are very highly rated by the credit rating agency, only that they can issue the commercial papers in the marketplace. The commercial paper, it gives an opportunity to whom? To the cash rich investors to park their short term funds. Now, if I am very rich, high net worth individual, then I can buy commercial papers, because the commercial papers come with a very high denomination. Okay, so it is meant only for the rich people. It is not meant for retail investors. Now, the Reserve Bank of India is the regulating body here. Now, it has permitted the companies to issue commercial papers since 1989. And has issued guidelines which are called the non-banking companies directions of 1989, the non-banking companies acceptance of deposit through commercial paper guideline to regulate this issue of the commercial paper. So the regulator here is the RBI. Now, who are the company who can issue commercial papers? Now, the commercial paper could be issued by companies whose tangible net worth is 4 crore as per the latest audited balance sheet. Now, when I'm talking about tangible net worth, it obviously we talk about we're eliminating the intangible part of it. So the net worth, tangible net worth is minimum 4 crore as per the recent balance sheet. Now, the company should have a fund-based working capital limit of 4 crore or more. Now, the company has to be listed in a stock exchange. Maybe you can be listed in more stock, at least you have to be listed in one stock exchange. Now, closely held companies whose shares are not listed in any of the stock exchanges are also permitted to issue the commercial papers, provided you fulfill all other conditions and you are permitted by RBI, because you cannot come to the market to issue commercial paper unless you are permitted by RBI. Now, you can the company has obtained a minimum credit rating there are various credit rating agencies in India like CRISIL, you have CARE, you have ICRA. So you can get so as per the different credit rating agencies, they have different signs of credit rating. So as per the RBI standard, you should at least get a CP2 credit rating from CARE, okay, Credit Rating Information Services of India Limited. Or A2 from Investment Information and ICRA, that is what I was talking about, Investment Information and Credit Rating Agency, A2 from ICRA, or PR2 from Credit Analysis and Research. Okay, this is CARE, this is CRISIL. The first one is CRISIL and ICRA, CRISIL and CARE. So from CRISIL you should get CP2, from ICRA you should get A2, and from KR you should minimum get PR2. If you are able at this credit rating or above, then only you are eligible to issue the commercial paper. Now there are several terms and conditions attached with the commercial paper. We'll just go and browse through few of them. Now the maturity period is 15 days and maximum is obviously 1 year. So see, these commercial papers are very short term. It could also be for 15 days only. Now the minimum denomination could be 25 lakh and multiples of 5 lakh thereafter. So obviously that is why I said that if you are a very rich individual, then only you can invest in the commercial paper. Because you see, for buying one commercial paper, you will require a minimum of 25 lakhs. So if you want to buy 10 commercial papers, you know how much the. So the point is, you are putting 25 lakh in one investment. So which only rich people can do. The commercial papers are issued as the USAN's promissory note. The other day we talked about the USAN's and the demand bill. Demand bill is as and when demanded on site. USAN's bills have a certain maturity date. So these are USAN's promissory notes which has fixed maturity date, and these are freely transferable and by endorsement and delivery. So quite transferable, these commercial papers. There usually what happens is, suppose you are buying a commercial paper worth 25 lakh, you don't have to pay the entire 25 lakh, but what you have to do is you buy it at a discount. Okay, so the differential amount between the discount and the face value, which is the 25 lakh, suppose you buy it at a price of, let us say, hypothetically speaking, suppose you buy it at 24 lakh. So difference between this 24 lakh and 25 lakh, which is 1 lakh, that amounts to the interest. And for, let us say, a period of, let us say, 3 months. So you get 3 months, for a period of 3 months, you get 1 lakh on an investment of 25 lakh. So you can compute the interest rate applicable on that. The issuing company, it is the issuing company that bears all these fees. What are the fees? The dealer's fees, the credit rating agency's fees, and any other charges if they are there. The issuing company, for example, we're talking about L&T issues a commercial paper. It is L&T which will bear all these fees. The stamp duties are also applicable in the commercial paper. That also is the responsibility of the company. Now, the CPs could be issued to any person or the corporate body incorporated in India, even in unincorporated bodies. Now, who are the participants in a commercial paper market? The participants could be a buyer participant, could be a seller participant. Now, we all know now by now that the seller is the highly rated companies, and who are the buyers? The buyers could be individuals, high net worth individuals. They could be corporate body. Incorporated in India, or they could also be incorporated bodies. Okay, so obviously they are all operating within India. Now the issue of for the issue of commercial paper, there is no co-acceptance by any individual or any institution. That means no concept of underwriting. Okay, so if the issue doesn't reach a particular level, you cannot bring in an underwriter. Now, again, there is no grace period for the payment. The holder of the commercial paper will present the instrument, and the issuing company will have to pay the money within the stipulated period of time. There is no grace period that you can ask for. You can there are also ceilings on the commercial paper. You cannot let's say like, for example, maximum amount that you can raise through this commercial paper is 100% of the fund based working capital that you can go for. So that is a ceiling. Now the there are several procedural aspects of issue of commercial paper. Now the point is, now the Reserve Bank of India has come up with the recent draft guidelines as in 2017, wherein they have introduced several modifications to these things. Now, some of the modifications is that they should obtain, the company which is talking about the commercial paper has to get credit rating from at least 2 agencies. Earlier it was like you can get credit rating from any of the agencies. Now you should get credit rating. This is the change that has been made by RBI from 2017 onwards. That at least you should get 2 credit rating. And when you can do that, you have to do that. You can do that only when your issue size is crossing 1,000 crore. Below 1,000 crore, you can get 1 credit rating. Rating from 1 agency. But if your issue size is crossing 1000 crore, then you have to get a credit rating from two agencies. So basically they're trying to avoid the possibility of a manipulation of the credit rating. Now the credit, so commercial papers will be treated as stand-alone product. Now there is a settlement cycle. We all know in case of shares, the settlement cycle has been migrated from T plus 2 to T plus 1. Similarly, the commercial papers, the settlement cycle is also uh, either T plus 1 or T plus 0. That means T is the day of transaction, date of transaction, and plus 1 is the number of days within which the customer is supposed to get his money. So we are now migrating. It was on the T plus 1 mode. Now we are talking about T plus 0. That means on the day that the commercial paper is presented for liquidation, in the same day, the account of the credit, I mean the client should be, or the investor should be credited with the amount that is liquidated from the commercial paper. So this is the T plus 0. So these are some of the changes that has been brought about in the commercial paper market. So we'll talk about the next kind of a financing, that is the intercorporate loan. Now you see there are short-term finance for the various companies. It is also being raised these days through within the organization, within the business entities. These are called the corporate loans. Now see, there will be many companies which are rich in cash. Okay, they are cash rich and they have surplus and idle cash. They have no avenues to invest this particular cash in any project or anything. So they would like to park their funds, and so that they can get and obviously for short term, in which they can get the rate of return, good rate of return. At the same time, you could have companies which are not able to arrange for short-term finances, either through the trade credit or through the commercial bank, because of stringent rules. So if you to bring these two companies together, it is just like a lock and key. One company has idle cash and wants to park fund for a short term. The other company wants short-term fund, but doesn't have the avenues. So if these two companies come together, then you could have an intercorporate loan. Now in an intercorporate loan, the surplus company will lend the fund to the deficit company for a very short period of time. And obviously he will charge, the lender company will charge a rate of interest for the certain number of days to the borrowing companies. Now the rate of return and the other terms and conditions of this kind of transactions, it will be over the counter, decided across the table by the two parties through negotiation. Okay, so now the point is this the intercorporate loans, they were governed by the provision of the Companies Act 1956. And but however, in this recent 2013 Companies Act, there have been certain changes which have been brought about by this new Companies Act. Now you can go through these statutory provisions prior to the 2013 and after 2013, and you can find out that there will be certain changes. So there is new ceilings applicable. There is a threshold limit that is there for the intercorporate deposits. Now, what are the kind of disclosures that a company can do, has to do regarding this intercorporate? Now, for how long you can, extend these grant of these loans? What could be the interest rate? So, depending on all these issues, that is regulations, you can go through the 2013 Companies Act regarding this thing of the regulations. Now, some of these things as per this new Companies Act for you is, let us say, a company can extend the loans or guarantees and acquire securities and make investment in any other company up to 60% of the paid up capital, okay, and up to 100% of the share premium or the free reserves, whichever is higher. Now, for example, if your paid up capital is 100 crore, and the reserves account is, let us say, share premium or the free reserves account amounts to, let us say, 300 crore. Now 60% of the paid up capital is suppose 60%, I mean 60 crore. And whereas the reserve, because typically in India, so we're talking about, of course, we're talking about free reserve. Suppose the share premium or the free reserve account amounts to, let us say, in our case, let us say 90 crore. So we're comparing between two things. Now 60% of 100 crore or 90 crore, whichever is higher. So here our share premium or the free reserve is higher. So you can go for investment in another company up to 90 crore. So that is what it means. Now, share premium account, I guess all of you know. Let us say, if let us say the share normally in India the share is a face value of 10 rupee. Some cases it is also 100. Now, suppose if the share price is currently the company issues share at a rate of, let us say, 60 rupee, then the 50 rupee per 10 rupee will go towards the paid up capital, and the 50 rupee will be accounted for in the share premium account. For share, it will be accounted for in the share premium account. So that account, or the free reserves account, the 100% of that, whichever is higher, is compared, and then that sets the limit for the intercorporate deposit. Now, if the company wants to grant the loan or guarantees above this prescribed limit, you have to pass a special resolution in the board, in the I mean the through the shareholders of the help of the shareholders and the board directors. It has to be passed. Now, the ceiling do not apply to companies which are under Section 12 of the SEBI Act. These are basically brokerage companies, the investment bankers, and all those. So it doesn't apply to those companies. Now, no company can extend these loans at a rate lower than the prevailing yield of the similar term. Suppose for the similar term, let us say 6-month term, the prevailing rate is 4.5%. You cannot issue this intercorporate deposit cannot be less than 4.5%. Okay. Now we talk about the bonds and debenture. Now we all know these are the one of the go-to source of finance for the working capital finances. Now we'll first see what these bonds and debentures are. Now, the debenture is ordinarily, it is a long-term promissory note for the purpose of raising loan capital from the public. Now, the companies can have, they can talk about loan capital. The loan capital could be a short-term loan from the banking. And when we're talking about non-banking, this is the loan from that you can get from the public. So these are called the debentures. Now, the fund promises to pay interest and principal. So at that point, at the time of issuing a bond, you specify the interest that you are going to pay and the face value of the bond. These are all mentioned before the issue of the bond. Now, the people who purchase your debentures, the debentures could be let us say 18-month to whatever limit you can set. The 18-month debenture has become very popular in India these days. Now, the people who purchase the debentures are known as the debenture holders. Now, there is an alternate. We also frequently use the name debenture and bond interchangeably. The bonds are specifically issued by the public sector companies in India. Now, when we're talking about types of debenture, what kind of debentures the companies issue? Now, they can issue three kinds of, depending on this particular criteria, you can talk about three kinds of debenture. The fully convertible ones, the partly convertible ones, and the non-convertible ones. Now, when we're talking about a non-convertible debenture, it is basically that, suppose a debenture's duration is, let us say, 3 years. So, which means and you pay semi-annual interest. Suppose the terms and condition mentioned is that you are going to pay semi-annual interest, and the duration of maturity of the debenture is 3 years. So basically, you are going to pay every half year, or 6 months, you are going to pay interest. So that means you are going to pay 6 interest to the mean to the depositor or to the debenture holder 6 interest, and the end of 3 years you are going to repay him his capital. So that is a non-convertible one. In a fully convertible one, what will happen is at the end completion of 3 years, then the bond will, the principal will not be repaid. For you, the depositor will get 6 interest for 3 years, and then at the end of 3 years, the entire face value of the bond will get converted into equity share. So, which is how many equity shares, what is the ratio of conversion, all these things will have been discussed, will have been disclosed at the time of issue of the debenture. So, no new terms and conditions can be built into at the point of conversion. So, this the ratio of conversion and all that has already been built into the issue document. So, the depositor knows how many equity shares is going to get. So, the entire of the face value of the debenture is going to be converted into equity share. So after 3 years, you will become the registered shareholder of the company. So you will be entitled to dividend and subsequently capital gain from the company. When you sell the share, so you will no more get back the principal. The last category of debenture could be the partly convertible ones. Now, when we're talking about partly convertible, it means that suppose the face value of a bond is 1000 rupees. So, and for 3 years, it will give you 6 interest because semi-annual interest. So, 6 interest, and at the end of 3 years, it might, if it is partly convertible, it is again mentioned in the at the time of issue. Let's say 50% of the face value will be paid, the redeemed. That means 500 rupees will be repaid to you, and the remaining 500 rupees will convert into equity share, and you will continue to hold the share until you sell them for the capital gain. So this is called a partly convertible. So the entire face value getting converted to equity share, fully convertible. Part of the face value getting converted to equity share, partly convertible, and the entire face value getting repaid to you or redeemed is non-convertible. So you can issue, and the company can issue any of these three kinds of debentures or bonds to get finance for the purpose of working capital. Now the point is this obviously when you're talking about issue of bonds and debentures, credit rating is compulsory. Now the conversion period more than 36 months is not permissible. Three years it is not permissible unless the conversion is made optional with call and put options. Okay, so here I need to explain this call and put options. Now the point is, if your conversion period is 3 years, then it's okay. 1 year, 2 year, 3 years, it's okay. But if you are talking about a conversion after 3 years, let us say after, suppose your bond has a maturity of, let us say 7 years, and you're talking about a conversion, that means converting to equity share. If it's a conversion after 5 years, then situation become unpredictable, more unpredictable. So the depositor has no clue to know what will be the scenario after 5 years. Okay, so after 5 years, what will be the condition of the equity market? The depositor doesn't know. So to give him a safeguard against that, the conversion has to be built in with a feature of the call and put option. Now what is that option? The call option gives you the right to buy a particular share at a particular price, whereas the put option also gives you the right to sell the particular share at a particular price. Now when there is an option, you don't have any obligation. So you if the situation is favorable to you, you exercise your option. Otherwise, you simply discard the option. Okay, so basically this is a kind of a sweetener to this. Otherwise, nobody will buy a bond which has a conversion feature which is more than 3 years. So the scenario becomes unpredictable. So you built in a sweetener into this conversion feature, which is a call option or a put option. That means the investor wants to sell the share at a price. He knows I will get this many number of shares, and he knows I can sell this particular share at this particular price. Well, if the market price is more than that, you don't have to sell at a, suppose the put option comes with a price of 250. That means you are sure that I am going to get 5 number of shares at the end of 5 years. Now each of these share I can sell at a minimum value of 250. Suppose At that point of time, the market share is, let us say, less than 250. So you will exercise your right and you will get 250 into 5, you will sell exercising the put option. So that amount is guaranteed to you. But if the market price is much more than 250, let us say now the share price after 5 years is trading in a range of 400. You need not sell at 250. You just simply discard your option. It's an option minded. There is no obligation. So you simply discard your option, and if you want to sell, you sell it in the at the market price. So you get 5 into 400. So that is the value of an option. So obviously, if you have the call option or the put option, you are guaranteed that if the conversion into equity is not going to harm your interest, so then the buyer can agree to this kind of principle. So this is a mandatory requirement from the SEBI, that it has to come with the call and put option. Obviously, the issue size is less than 1000 crore, then one credit rating should do. If it is like commercial paper, if it is more than 1000 crore, then it has to, I mean, be with two credit rating agencies. Now, the companies which are issuing debentures having a maturity up to 18 months, they are not required to appoint trustee or to create debenture redemption reserves. But if it is more than 18 months, then you have to create the debenture redemption reserve. We'll talk about those things in the next slide. Now, the point is, what are the features that we should know? We all know that the stated interest rate on the debenture is ordinarily fixed. Why I'm saying ordinarily fixed is because that is, at the time of buying the instrument, the depositor knows exactly that I'm buying this instrument for, let us say, 25,000, and the interest rate is going to be, let us say, 9%. So he knows every 6 months he's going to get the half yearly interest on the stated amount. So he knows, he have a relative certainty about the cash flow that is going to have. Well, there are also floating rate bonds or debentures which are floating rate. Then also the investor knows about his cash flow 6 months in advance, because when we're talking about floating rate bonds, the floating rate of interest is always benchmarked with some kind of a benchmark rate. Okay, so a minimum benchmark rate plus 0.25% could be the floating rate. So 6 months in advance, you will know that what is going to be my cash flow. So the depositor has relative certainty regarding the cash rate. So the interest rate is more or less fixed for him. Now, the maturity, it comes with a specific maturity. Could be minimum, could be 18 months, maximum could be, like India also have 25-year maturity bonds. So the maturity could be anywhere between 18 months to 25 years. Well, the redemption is basically the repayment of the principal. So the repayment, as we discussed just now, when the time of repayment comes, then the company will have to shell out a huge amount of money, because 500 crore, 1000 crore, if you're talking about this kind of a issue, the arrangement of that size of finance is not that easy. Now, see, the point is, just now we talked about, if it is less than 18 months, then you don't have to create a reserve for the redemption. But if the maturity is more than 18 months, obviously the uncertainty builds into the bond, because the financial condition of the company, if it weakens, then the company may not be in a position to within a year, 1.5 years. Well, we know something drastic might not happen within 1.5 years, 18 months. But 5 years down the lane, 7 years down the lane, 10 years down the lane, we don't know what will happen to the financial status of a company. If it weakens substantially, the company might not be in a position to repay the principal. So in order to guard against such kind of a scenario, SEBI has mandated that if the bond is more than 18 months of maturity, the company will have to create a reserve, which is called a sinking fund reserve. Now, in a sinking fund reserve, the company will have to transfer a fixed amount every year as an annuity, and the reserve keeps on building every year, so that by the time the maturity of the bond comes, let us say 7 years later, the reserve would have built up to the amount that is needed to be repaid. Okay, suppose your issue size was 500 crore, so you would have transferred an amount to this sinking fund reserve every year. So by the end of 7 years, the reserve would have grown to 500 crore. So then there is you use the reserve to repay the bond. So the point is, and why are we doing it? Because with as the time with I mean the elongation of the time, extension of the time, we are not sure about the financial condition, so we are building a safety net for the investors. Now we talked about this callback provision. The bond, the suppose the a bond has been issued for a period of maturity of 7 years, but the company has a right, if it builds in this buyback feature or the callback feature, the company has a right to call back the bond before the maturity. Suppose a bond is being sold at a maximum maturity of 7 years, but callable in, let us say, 3 years. That means after 3 years time, if the company desires, it can buy back the bond from the depositor at any point of time after 3 years. Now, why does a company do it? Now, suppose in the regime of interest rate fluctuation, now suppose you had issued a bond at a coupon rate or interest rate of 11%. Now the prevailing rate on these kind of bonds is, let us say, 9%. So you would not like to continue with the higher interest rate bond. Rather, you would like to call back the bond and probably go for reissue at a rate of 9%. Now we're talking about the trust deed. Now this is the indenture. Now this indenture is that you have to appoint the trustee. Now what is the job of the trustee? The trustee will see to it that you are obeying all these things that is mentioned in the contract. I mean the trust deed, the interest rate, the maturity, the kind of redemption you're doing, whether you are building a sinking fund or not, all these things will be overseen by the trustee on the behalf of the investors. Obviously, they do it for a fee. The trustee appointment is the job of the company. The SEBI says that the companies which are issuing debenture with a maturity of 18 months, they are not required to appoint the trustee. Or they are not required to build up the sinking fund reserve. Okay, so obviously because a short term, if the bond is a very short term one, then you don't need a indenture, or the indenture is basically also known as debenture trust deed. Now you don't have to have a trustee for a 18-month debenture, or you don't have the requirement of a reserve. Now the bonds could be secured, could be unsecured. I mean, we have been talking about the kind of security or the charges. If the bond is secured, if it has a charge against an asset, it is unsecured if there is no charge against the asset. So the obviously the secured bond is senior as compared to the unsecured bond. So at the time of liquidation of a company, the priority will be secured bond and then the unsecured bond. And the rate of return that the client gets on this purchase of a bond is known as the yield. So the yield could be computed based on the market price of the bond at any point of time. Now, as we all know, debentures are basically senior securities. So they have the first claim on asset and the first claim on income. Now, the claim on income, the first claim, why I say is because the interest is the first charge that you deduct from the operating profit. Okay, so the first charge is for the interest of the debenture holder. So that is they have the first claim on the income, and the claim on asset ordinarily arises at the time of liquidation of a company. So they also have the first right of the asset. Now we'll talk about another kind of a non-fund based source of finance. Now that is called the factoring. Now the factoring, it is an agreement under which the receivable that arise out of the genuine sale of a good or a service, they are handed over to specific funds. Okay, these are called, that means basically one kind of one kind of banking fund that we talk about is discounting of bills. Now, factoring is very different from the discounting of bills, because you see, the in case of we have a tendency to confuse between this factoring and discounting. So, see, in case of a discounting, I suppose I am a company and I have sold things worth, let us say, 10 lakh rupees on credit basis. So means I have created a bills receivable of 10 lakh rupees. So if I need the fund, under bills discounting, what I do is, if I need the fund of the 10 lakh rupee, I go to the bank, to my bank, and I sell the, the bills receivable to the bank, or I get it discounted from the bank. So in a sense, what the bank does is takes my bills receivable for 10 lakh rupee and probably pay me a little reduced amount. Maybe let us say the bank can pay me, let us say 9 lakh 22,000 rupees. The bank will pay me, and the 80,000 rupees bank deducts as the charges. And on the maturity, let us say after 90 days that the bill will mature, the bank will take the receipt, the bills receivable, and present it with the customer and collect the amount of 10 lakh from him. Now the issue is, so in this transaction, the bank collects 10 lakh rupees from the customer at the end of 90 days, and gives me 9 lakh 20 immediately after the day of the sale. When the bill is created, I immediately go and discount it with my bank. So the bank will charge some amount and give me. So the 9 lakh 20,000 rupees is being given to me by bank. So it is basically a bank credit. In case of a discounting of bills, the amount is a bank credit. Whereas in case of a factoring of receivables, it is not a bank credit. It is, the money will not come from the bank. So this is basically a non-bank arrangement. So basically, who will do that? These companies who liquidate our bills receivable, they are called the factors. Okay. So what they do is, suppose the big commercial houses, they are generating bills receivable day in and day out. So sale is happening at all points of time. So, and the sale is mostly on credit basis. So basically every day thousands and thousands of bills are being created. So the company doesn't take the botheration of running after the client and collecting the bills from them when it is due. The commercial houses do what is, they sell their bills to companies which are specialized in collection of bills, and these are called the factoring factors. Now these are the financial intermediaries. So they will buy my bills, and in lieu of that, they will immediately release me the cash. So here you see, the cash doesn't come from a bank, so it is a non-bank arrangement. It comes from a factor. So the factor therefore becomes responsible for the collection of these receivables. Now the factor is in possession of thousands and millions of bills from different commercial houses. So they will track each of these bills. They will see when each of these bills are maturing, and then they remind the client, and then they pursue the client for collection of the particular bill receivable. Now the factor pays the whole or a major part of the dues to the buyer. Basically, it doesn't, it will not obviously pay the full part, because it will charge something on that, which is the factor fees. Now so I as a seller, I'm a commercial house. I sell my bill to the factor, and factor will immediately within a day pay me the amount. So my liquidity is taken care of, and my cash cycle is completed. So while talking about the working capital, we talked about a operating cycle. So we start with buying of raw material, and then it goes through several processes. The sale happens, and only when the collection happens, my cash cycle is completed. But now I don't have to wait for the 90 days of the credit period. I sold my goods to the end user customer, but the bills I sell to the factor, I immediately, so my operating cycle is substantially shortened because of this particular arrangement. So that is the job of the factor. And the factor realizes the amount from the buyer on the due date. Now, if I tell you some of the well-known factoring companies in India, we can look at a company called the SBI Factor and Commercial Services. The SBI Factor and Commercial Services is a company which has been promoted by State Bank of India, Union Bank of India, and Small Industries Development Bank of India. So three banks have floated this particular factoring company. You have a CanBank Factors Limited. This is a company promoted jointly by Canada Bank, Andhra Bank, and SIDBI. you have the first the factoring private factoring company which came up in India in 1997, which is called the Foremost Factors Limited. And we also have a very popular factoring company in India which is called the BB Financial Services. Now, when we talk about this, the obvious question that comes to mind is while you are selling the bills to the factoring agency, and the factoring, what if the client doesn't make the payment? So obviously, depending on that, this kind of a risk the factory is taking. The factoring could be divided into two types. One is a recourse factoring, the other one is a non-recourse factoring. In a recourse factoring, the factor has recourse to the client. That means if the client doesn't pay the amount, okay, so the receivable purchase turn out to be irrecoverable, doesn't, the customer doesn't pay the amount, then the credit risk will not be borne by the factor, so that is called the recourse. So he has recourse to the client. So the factor is entitled to recover the amount from the client, from the advance or the interest for the period or any other expenses incurred by him. So basically, the credit risk lies with the, the commercial house in case of a recourse factoring. In case of non-recourse factoring, the factor takes up the credit risk. Okay, so he doesn't have the recourse to the client. Now he has to bear the loss that is arising out of the non-payment of dues of the buyer. Now suppose my customer doesn't make payment on the due date, then the loss or the risk is being entirely borne by the factor. Now, obviously, when we're talking about a factor which is going for recourse and non-recourse financing, the non-recourse finance or non-recourse factoring service will come with a higher charge than the recourse financing. So, I think these are the kinds of non-bank credit that are available for working capital. So, we end our discussion here. Thank you.